time for your weekly financial workout with your elite personal trainers, Ryan and Bob Payne, guiding you on how to build a stronger and more robust financial plan. So get ready. We're about to pump you up. Live from the greatest city in the world, this is No Pain, No Gain.
Good morning, it's No Pain, No Gain Financial Radio. I'm your host, Ryan Payne, President of Payne Capital Management, along with Chief Investment Officer, the man with the plan, and my father, Mr. Big Bob Payne. Good morning, Dad.
Good morning, Ryan. I'm shocked that you're with me this morning now that you're a big star on CNBC almost on a weekly basis.
I think I'm a legend in my own mind. That's about it. So
you're always a legend with me, son.
Hey, I'll take whatever fans I can get, even if it's your own father. So I'll take that. Thanks, Dad. Well, we got a great show this morning, as always, to help you on your path to financial freedom. So let's talk about do-it-yourself retirement planning. Let's face it, there's many areas of our culture that has a do-it-yourself mentality that's really become popular. They even have a do-it-yourself TV network where you can watch shows about things like home renovation, landscaping, interior design. So let's talk about what the do-it-yourself mentality looks like when we're talking about retirement planning. Bob, when you come across somebody who doesn't have a financial plan, what do you find are the reasons that they're taking this do-it-yourself approach?
Well, it's like anything else when it comes to do-it-yourself. It's all about saving money. It's about the cost of paying someone else to do it. But there are certain things which you really shouldn't take a chance on doing it yourself. You know, for example, anyone could do brain surgery, but I wouldn't recommend it. No matter what you save, it's just not worth the risk. Or plumbing. I mean, if you can repipe your house or put in a new bathroom, but one leak could destroy your whole home. And the third thing is your money. You know, if you make a mistake and you make a permanent mistake, once you lose that net worth, it's hard to get it back. So I think that that's the big risk. But what I see is there are some people who are really good at managing money and really like it. But what they fail to recognize is that money has an emotional component. And I don't know, over my 40 years, Rye, over your 20 years, have you ever met an unemotional investor?
No, it's a good point. Definitely is a very emotional thing, and I think that's one of the values to having a coach. You know, they always say even Tiger Woods has a coach, right? One of the greatest golfers in the world has a coach as well, because you're right, you can't see what your blind spots are. And when it comes to your own personal net worth, the money that's going to get you through retirement, it's going to be even more emotional than, you know, something that's it's hard to have a cold eye, let's say, when it comes to your actual own finances and your own money, and markets are a very emotional place to be.
Great analogy. I agree with you. It's like a personal trainer. You know, you can only push yourself so hard, but it's really hard to get you to do the things you really have to do, you know, to get to that next level of fitness. And I think a personal advisor can do that. But you know, the other thing is you don't know what you don't know. You don't know, you know, you think you have access to all the markets today, but you don't. You know, there's certain pricing levels that we make available to our clients that we can only do as a collective. You know, we're able to get them institutional pricing on their bond portfolio, which you can't do on your own. You're stuck with bond funds or closed-end funds or high-priced retail individual bonds that are just what's left over, you know, after the big money's done picking through the heap. So I think in a lot of cases, you cut off your nose to spite your face to save a few dollars, when your retirement, you know, outliving your money is the biggest risk we all face. And I think having an advisor really fits the bill. But, you know, there's another huge risk, Rye, of someone who is really good at managing money, really enjoys it, doesn't have any other hobbies, is what happens to them when they're no longer on God's green earth.
Yeah, no, it's a good point. And I met with a client recently. That was their main concern is he loves to manage the money. He loves the markets. He's very engaged in it. And, you know, he actually looks at it as a way to keep himself young in retirement because it keeps him engaged. But, you know, he made a great point. He said, my wife knows nothing about this stuff. And if I was to pass away tomorrow, she'd be left holding the bag, not knowing what to do at all. And, you know, some of the portfolio investments he had were very risky, which when you're keeping your eye on it day to day, every second of the day, it's one thing. But all of a sudden, you're not on God's green earth, and your spouse has to deal with this, and she has a risky portfolio. She doesn't know where everything is. It can get really messy really quickly, and we've had clients like that where, you know, the spouse has come in when their husband or wife has passed away and they just don't know anything that's going on. So I think, as much as you may love investing, love doing it yourself, you need to have what we call a contingency plan, and lay that stuff out so that, God forbid, something does happen to you. There is a team in place. There is a strategy in place so that your spouse has a smooth transition, especially in a time like that, which is just going to be, complete turmoil. You want to make sure that the finance portion is locked down.
That's a great point, Rye. I had a client come in the other day, that was just referred to be new client. And he said, look, I'm getting older. He said, I'm a CPA by training. He said, I understand money. He said, I've managed this myself my entire life. But he says, I'm getting confused. And he said, I don't want to make a mistake. And I looked over the portfolio and I said, quite frankly, you've done a very good job. And he said, Bob, let me be perfectly honest. He said, I made a lot of mistakes. He said, back some of my earlier days, my 401k, he said, I put all my money into a stock called Nortel, which was a telecom company. And all the research said it was a great company. And I lost every dime. So, I did a decent job of what I had left, but I made a lot of mistakes. And a lot of people don't want to be honest about their own, vulnerability or their own mistakes that they make because, I don't know about you, but when I'm in retirement, I don't think I want to spend the kind of time we spend doing due diligence and research and all the education that we do. I mean, I work 11, 12 hours a day. To me, that's not a hobby. That's not fun. I mean, it's fun for me while I'm working, but I certainly would like to do something different when I'm retired. So I think a lot of people, even if they do like it, they don't realize the risk they're taking by not being an expert. And even though you and I do this 24/7, we're still not experts.
Yeah, no, it's a good point. And I think that's the other thing is if you're honest with yourself, you might think you have a handle on running the money, but we have a tendency to look at the past. You made a joke last week, Bob, that, when you ran track in college, I ran track in college, and the older we get, the faster we were. And we tend to kind of tune out the fact we made a lot of mistakes with our investments back in the day, and we forget when 2008 hit, what that felt like, and how hard our portfolios got hit because things have recovered since. But do you really want that to happen again? And, do we really want to look with the rosy-colored sunglasses on how good we are at managing money and forget that it is treacherous? I mean, there's some scary times, and do we want to go through that alone trying to figure out what our portfolio should be doing on the next correction? So I think for all those reasons, especially as you're getting close to retirement, especially as you're in retirement and you know that you're not going to be able to keep this up forever and your spouse needs to be taken care of, it's so critical to have the right plan in place. So if you want a second opinion, you want a contingency plan, or you want to get just a plan in place that addresses all these issues, here's your shot to do it. If you're one of the first 10 callers and you have over $200,000 saved for retirement, Bob and I will run for you our total financial master plan, and we'll do it with no obligation or cost. It's a full review that addresses everything. So if you actually bring in last year's tax return, we'll have a CPA review it. Make sure you're not paying unnecessary taxes. If you bring in your wills and trusts, dust them off, take them out of the basement. We actually have an estate planner that will review those to make sure that your estate plan is up to date and what changes you may want to make. And then finally bring in all of your statements, 401ks, IRAs, brokerage accounts, annuities. We're going to analyze everything on a simple 3-page document, our investment analysis spreadsheet, and we're going to look at diversification. What risks, blind spots, or pitfalls you have in your portfolio? Bob and I will point that out for you. We're going to look at the fees. Are you being overcharged on your investments? We're going to break down all the costs on your portfolio, especially those hidden costs that you have in your mutual funds, annuities. And then we're going to look at income. Income is so critical in retirement. Can we increase or optimize the income on your portfolio? Then we're going to tie it all together into one total financial master plan, and we're going to answer that age-old question: are you going to outlive your money, or is your money going to outlive you? Utilizing strategies now we've literally worked on for over 40 years to take your family from point A to point B with the least amount of risk and the highest odds of success.
So call us at 844-PLAN-NYC. That's 844-752-6692. If you're one of the next 10 callers with over $200,000 saved for retirement, our team will run for you our total financial master plan. Now, there's no obligation and there's no cost. Just call us at 844-PLAN-NYC. That's 844-752-6692. This is No Pain, No Gain Financial Radio.
It's time for the weekly No Pain, No Gain market update with the team at Payne Capital Management here in New York City.
Good morning. This is Bob Payne, Chief Investment Officer here at Payne Capital Management. The big news on the Street of Dreams was the Dow Jones Industrial Average marked a major milestone, surpassing 22,000 for the first time in history. It only took the Dow 107 trading days to surge to 22,000 from the recent all-time high of 21,000. And that makes the market up 2,000 points for the year in 2017. Now, the Dow Jones is a stock index, tracks a composite of 65 blue-chip U.S. companies, but not all companies have contributed to this year's rally. Over half of the return has come from the rise of three stocks, Boeing, Apple, and McDonald's. And the big factor behind the big three's outperformance? The amount of business they're doing overseas. According to J.P. Morgan, global economic growth outside the U.S. is running at its fastest pace in 4 years. Couple this with the recent weakness in the dollar, this leads to an environment that should continue to benefit globally focused companies. And so the way for you to benefit is to be certain that you have a globally diversified portfolio. So if you're sitting there wondering if your portfolio globally diversified and able to participate in the next move on the Dow Express, why sit there and wonder what you can know? Give us a call at 844-PLAN-NYC. That's 844-752-6692. This is Bob Payne of No Pain, No Gain Financial Radio.
For all the latest information and news that you need to retire successfully, make sure you go to BeBullish.com. That's BeBullish.com.
Lions, Tigers, and Bears, oh my. You might remember that famous Judy Garland line in The Wizard of Oz. And just like Dorothy, the lion and the Tin Man had to watch out for lions, tigers, and bears on the yellow brick road to Oz. Bob and I want to warn you about the liars, charlatans, and bears you're going to encounter on the road to retirement. You know, Bob, who are those liars on the road to retirement that we need to be aware of?
Well, there are people all along the yellow brick road who tell the big lie, right? And the big lie is that you can get market returns. You can get financial asset returns in other instruments that give you guarantees and take out all the risk. And you're going to be better off if you invest that way as opposed to investing in the financial assets that are liquid, that have been performing for hundreds of years, and come at low cost. So the big lie is you can get market returns without the risk. And there's no way to eliminate the inherent risk that's in the financial markets. So when someone tells you about an annuity, gives you all the upside and none of the downside, and they use that one word, that is a total lie, which is guarantee, I want you to run. Because there are no guarantees when it comes to financial assets. All financial assets are volatile. It means they're risky. They change in price. Price of your home, price of the building you work in, price of your portfolio. There's no such thing as a non-risky financial asset. So when you look at guarantees, and they throw that word around like, all the time, it's backed by a company. That's not a guarantee, right? A guarantee is a guarantee they'll pay, but if they go under, they can't pay you. So if you invest in a company, that's a guarantee? Hardly. So that's the big problem. That's a big lie that you see out there that keeps people from investing properly. So they start to invest in things like annuities or life settlements, which give you the safety of a CD with a guaranteed return by God. These things are fraught with risk. There's lots and lots of fees, and there's not as good a return as they would like you to think. So you see these advertisements, and, it's like the sirens in mythology that they want to bring you into the rocks and have you crash and burn, looking for safety. So that's the big problem. The other thing I find, Rye, are the bears, the perma bears out there who keep people from investing properly. When was the last permanent dip in the financial markets?
No, that's a good point. I mean, you hear, all the time that, we're going to have a collapse, and that probably happens every single year consecutively. And we've actually talked that this is the most hated bull market of all time because we've literally gone up for 8.5 years. And all you can hear when you read the news, and this is why we always talk about financial pornography, is negativity, that the next bear market's around the corner. And, it also, you've mentioned this in the past, but I think it's a good point. It sounds so smart to be negative. For some reason, it sounds more sophisticated to seem like I have some inside information into what's going to happen into the future. And, to your point, the market's been going up for 200 years. And it's only really paid to be an optimist as an investor. Complete counterintuitive, because the market goes up, more than 2/3 of the time, markets are in an upswing. So, being negative, being pessimistic actually hurts you as an investor. It's a terrible way to invest your money, especially when being an optimist long term has always paid you well.
So, Ryan, if the big lie is out there are no guarantees and that markets are volatile and you can't get a market return without taking market risk, why do these charlatans sell these products?
I'm going to take a wild guess, Bob, but I think it has something to do with the big fat commission that they make to sell fear and convince you that this is the way to create safety in your portfolio, which ends up just being a very expensive way for you to protect yourself against the realities of risk that are in the world.
Commissions are very large. I mean, I love on our local TV station, there's a crash-proof retirement ad where you don't pay any fees. However, he gets a commission from the insurance company. But why would an insurance company be motivated to pay a commission to a salesman if it's not coming from the client's product?
Well, and I think that's the thing. There's a lot of pitches out there for a lot of these different types of insurance products that offer you these quote-unquote guarantees, or, all the upside of the market without downside, or they throw out there you can receive a guaranteed 5-6% return. But when you look at all these products, what I want you to remember is whenever they give you something, you're giving something up. It's not, it's not just a blanketed, I'm getting 6%, or it's not just a blanketed, I'm going to get all the upside of the market, not the downside. You're going to give something up in that equation, and that's something you give up typically, and you don't see it, is in the form of that commission that the insurance company and the insurance salesman somehow are getting. And for you, that's going to be a lot more money out of your pocket than you realize over your lifetime. Yeah,
it's so true. I mean, we always say at Payne Capital Management, simplicity over complexity. It's almost as if the more complex the instrument, the more complex the prospectus, the thicker the document that comes along with your contract, usually means there's a lot more commissions, there's a lot higher prices, a lot of fees that are coming out of that portfolio that you're not necessarily understanding. So we see that whenever we come across some of these more complex insurance products or these non-traded real estate investment trusts where they tell you they're going to pay you 8 to 9%. What they don't tell you is that you're just getting back your own money, and they somehow equate that to yield. At least that's the understanding that you might have when you invest in something. But it's almost as if all these different products, these oil wells, these currencies like dinar, non-traded real estate investment trust, annuities, there's a lot more liquid, less costly, more tax-efficient way to do it. But they're not necessarily going to tell you about that because there's no commissions on products like that.
And that's the other thing, Bob. Not only, are these things not quote unquote really guaranteed, but two of the things that in my mind that are so important, especially as you're getting close to retirement and in retirement, it's so key to have liquidity, to have access to your principal, and also defending against taxes, right? I mean, I talk about this on the show a lot, but getting a lower return on a tax-efficient investment is typically better than getting a higher return on a tax-inefficient investment. So focusing on taxes and liquidity are two of the most important points. And these products that they sell, or these liar charlatans and these bears, don't take that into account. And that's probably one of the most important things you need to be concerned about as a long-term investor.
I know we're going to address shortly our financial pornography section, but it's always invariable. Whenever there's a down day in the economy or the financial markets, they roll out these same perma bears. What's a perma bear, Rye? What is that?
Someone who's always negative. It's always pessimistic about the future.
Well, I've been in this business for 42 years, and the perma bears have been permanently wrong. So, Rye, at some point in the future, I just hope that the financial pornography channels eliminate all the perma bears, because all they do is prevent good people from achieving the returns that the market so generously gives. And if you're not sure if you're listening to the right people, or you have your portfolio positioned properly for this big booming bull market that we're experiencing, well, we'd like to offer, if you're one of the next few callers and you've saved at least $200,000 for retirement, Ryan and I will run for you our total financial master plan. Now, there's no obligation and there's no cost. All you have to do is give us a call. And if you're one of those next few callers, here's exactly what we'll do for you. We'll have our CPA review your tax return to make sure you're utilizing all the tax benefits that are legally available under today's tax code. we'll look over your estate plan. If you don't have an estate plan, we'll get you on the path to getting an estate plan. But more importantly, that should be reviewed every couple of years, and we'll have our estate planning attorney do that just for you. And lastly, we'll look at all your investment statements. No matter where you custody those assets, we'll put it all together in our famous investment analysis spreadsheet. Now, this is a simple 3-page document that breaks down all the key elements of a successful portfolio: diversification, cost, and income. We're going to look and see if you're truly diversified across the investment classes and within those investment classes. We're going to look at all the fees and make sure that you're not being overcharged on your investments. We're going to look at every cost in your portfolio, including those insidious hidden costs, the ones that are buried deep into that annuity contract or that's in the prospectuses of your mutual fund portfolio. And lastly, we're going to look at income, and we're going to look at whether or not we can optimize or increase the cash flow that you're receiving from your portfolio and make it more dependable income in retirement. And lastly, we're going to put it all together into one wealth projection, which will answer that age-old question: are you going to outlive your money, or will your money outlive you? And we're going to help you do this by utilizing strategies that my family has been working on and perfecting now for 4 decades. That's correct, over 40 years. We want to help you at Payne Capital get from point A to point B, your dreams and goals, with the least amount of risk and the highest odds of success.
So give us a call at 844-PLAN-NYC. That's 844-752-6692. Be one of the next 10 callers with over $200,000 saved for retirement at 844-PLAN-NYC. That's 844-752-6692. Don't waste time. Get the full review today at 844-PLAN-NYC. That's 844-752-6692. This is No Pain, No Gain Financial Radio.
Hey, we know you love the show, but we also know you're on the go. That's why we want to make No Pain, No Gain more accessible to you. Go to BeBullish.com and download the show. Listen on your schedule. You can even find a written copy that's helpful for you, whether you're in your car or at the office. Take us with you and learn about your finances. Visit BeBullish.com. That's BeBullish.com.
It's time for Financial Pornography of the Week. This is where we scour the daily financial news and call out the biggest offenders of offering obscene and profane financial guidance to help you protect yourself from making any ill-advised financial decisions. And Big Bob, what did you find this week out there in the world of financial pornography?
Well, Raymond James has an investment strategist, right, by the name of Jeffrey Sott, and he just recently reread a book called The Investor's Guide, written by a fellow named John Curran, and he talked about the psychology or the idiosyncrasies that investors have in making decisions and how they feel about risk. And so they went through a series of questions to see how people would respond to risk and ascertain how they feel about risk. So I'm going to ask you the same questions to see if you follow along with the average investor. So the first was, if you're faced with the possibility of 2 possible gains, which one would you choose? A 100% chance to win $3,000 or an 80% chance to win $4,000? Which would you choose?
Oh, man. I'm conservative. I would go for the 100% chance of getting $3,000.
As did everybody else. Everybody else, yes. But the thing is, the second chance of winning, or 80% by the $4,000 winner stands to gain $3,200. So in the long run, if you come out ahead by making the second choice consistently. But most people are bothered by that 20% chance of getting nothing, which tells psychologists, what stock theorists knew all along: investors in general prize certainty and abhor risk.
Right.
So it sounds simple, doesn't it?
Sounds very simple, and also explains, like our last segment, why investors, why we buy things like annuities and things that have the word guarantee in them. Yeah,
well, the next question flipped that whole thinking on its head. Because when people are confronted with prospective losses, then they turn into riverboat gamblers. So here's, which one would you choose here, Rye? Would you choose a certain loss of $3,000 or an 80% chance of losing $4,000 and a 20% chance of losing nothing? Which would you take, the certain loss or the chance of losing nothing?
I'd go with the certain loss, believe it or not, on this one. Maybe just because I've been an investor for so many years.
Well, most of these people took the opposite. They gambled on the second choice, which offers a 20% chance of, escaping unscathed, even though it's riskier. So it's almost as if the horror of losses exceeds even their aversions to risk. They're willing to take risk, even bad risk, contrary to what we've always believed. So risk aversion is not always the guiding light of decision making when it comes to investing. So I got one more question, Rob. One more, a third one. And to measure, how deep the fear of loss runs, the same psychologist followed up with a pair of questions. You were invited to wager on a hypothetical coin toss. So heads you win $150, tails you lose $100. So the potential payout is 1.5 times the possible loss. But you know what most people did?
They
refused even to make a bet.
Really?
Yeah. So loss aversion is surprisingly very powerful. And it really even keeps people from accepting good bets, both in flipping coins and in selecting stocks. And to your point, that's why a lot of people go for these phony guarantees, because they think they're eliminating risk.
Yeah, and I think the other good point there is just about the investment in hope, right? When the markets go down and you may hold something longer than you should because you're hoping it'll come back, or you'll double down on a position. And this happens a lot when you have a down market, because you don't want to take the loss. So you have what we call an investment strategy in hope, which in our minds is probably one of the most dangerous strategies you can possibly have. So, not having the proper risk management techniques in your portfolio and a way to limit losses in your portfolio is a very dangerous game to play, because markets are uncertain. Markets can be very volatile. We forget that because we've been in a year with very, very low volatility, which is rare to have this kind of low volatility. But we see that all the time, especially in a down market where you'll hold on to something longer than you should, and you won't put the right risk management techniques in place.
Yeah, or you're so afraid of that loss you can't take that first step to even just dollar cost average, into financial assets. This same strategist was at a meeting last week, and he encountered one of their firm's clients who's been sitting on a mountain of cash. And, for all the reasons why you can't invest now, because the market's overvalued, or because, North Korea, or there's geopolitical risks that are uncertain. You don't know what's going to happen with the White House. You don't know what's going to happen with Congress. So gave all the reasons why they can't invest in this market. And I think it was a pretty illuminating point when the strategist said, look, when that client finally invests, call us, because we want to get out, when they finally cave in and, and capitulate, from their risk aversion. I mean, after 8 years of a bull market and you're still sitting in cash, you've missed a heck of a move.
Yeah, that's a great point. And that's one of the reasons why we say cash is trash. And again, even if you're sitting in cash and you're wondering when's the best time to get in the market, there's conservative strategies you can put your money into. And it's going to be about time in the market, not timing the market. So it's just this idea that you're going to find this magical day that the market's going to pull back and it's going to be the right time to invest. It's just never going to happen. It never does. And that's one of the reasons why this market just keeps chugging along higher and keeping people from getting back in the market if you've been sitting there in cash waiting for your entry point. And it doesn't matter. At the end of the day, it doesn't really matter. If you're diversified over markets, you're compounding your money, creating cash flow from your investments, dividends, and interest. That's what's going to get you to your goals, not market timing. And I think we forget that as we watch the financial pornography out there all the time that makes you believe that you can time the market, and there is a lot of risk in some sort of downturn that's going to happen tomorrow.
Well, that's a great point. I mean, Jamie Dimon, the CEO of JP Morgan, said this week, we're growing at 1.5%, 2% a year in spite of the stupidity and political gridlock. The American business community is powerful, the economy's strong, and it grows regardless. And in the beginning of this year, right, everybody kept telling us how, the dollar's going to go up. Well, the dollar went down. Interest rates are going to go skyrocketing up. Interest rates have actually gone down. And the largest companies in the country had just come in with back-to-back quarterly earnings and double-digit growth. So people don't understand that, companies are always working hard to improve their situation, that, the cost cutting has been going on in the last couple of years, continues to happen. Inflation was lower than people anticipated. So all the things that people anticipate or try to predict and they take as gospel turn out to be wrong. And the only way to solve that problem, the only way to eliminate, making big major timing mistakes is to have an investment strategy based on your goals. And it's, anybody who invests on anticipation or on what they hear in the news or what people believe, it's just amazing to me that the market confuses the majority opinion at the time. In other words, whatever everybody believes, there's like this collective belief on the part of all investors, because we all read the same things, we all listen to the same programs, we all come to the same conclusion at the same time. And you know what the market does? It doesn't reward that type of thinking. It does the opposite, because all that information is already priced in.
Yeah,
so it's really, to be a smart investor, you don't need a high IQ. You need a plan.
Yeah, exactly. And if you're sitting there wondering to yourself, I need to stop having a plan in hope, a plan of anticipation, but a real plan that's based on my goals, here's your shot to do it. We still have a couple slots left. If you're one of the next few callers and you have over $200,000 saved for retirement, we'll put together a real financial plan, a total financial master plan, and we'll do it with no obligation or cost. And that will look at everything for you, everything from taxes. If you bring in your tax return, we have a CPA that will review that to make sure you're not paying unnecessary taxes. If you bring in your legal documents, that's the wills, your trusts, we have an estate planner that will review that to make sure that's up to date and any changes you may want to make to your estate plan. And finally, bring in all those statements, bring them on a big brown paper bag. We'll go through all of it for you, and Bob and I will build our famous investment analysis spreadsheet that analyzes all your investments. We're going to look at risk. How diversified are you? What pitfalls, blind spots do you have in your portfolio? We'll point those out. We're going to look at fees. Are you being overcharged on your investments? Do you own a lot of high-cost annuities, mutual funds? We'll break down all the costs in your portfolio. And we're going to look at income. Income is so critical in retirement. We're going to show you how to increase or optimize the income on your portfolio. Then we're going to tie it all together into one total financial master plan, and we'll determine, is your money going to outlive you, or are you going to outlive your money, with strategies that we've literally worked on our family for over 40 years to take your family from point A to point B with the least amount of risk and the highest odds of success.
Don't miss out. Give us a call at 844-PLAN-NYC. That's 844-752-6692. If you're one of the next few callers, you've saved over $200,000 for retirement, we'll run for you our total financial master plan. No obligation, no cost, no strings attached. Just give us a call today at 844-PLAN-NYC. That's 844-752-6692. This is Bob. This is Rye. You're at No Pain, No Gain Financial Radio.
Your personalized path to financial freedom awaits at Payne Capital Management. For more information, go to BeBullish.com. That's BeBullish.com.
It's Ryan Payne, Bob Payne, No Pain, No Gain. And if you want to know more about myself and Bob, you can look us up on the World Wide Web, BeBullish.com. That's BeBullish.com. You can see a little bit more about what Bob and I are about. Also, if you have a question for myself or Bob, you can always email us. Questions@BeBullish.com. That's questions@BeBullish.com. And if it's a really good question, we'll answer it right here on the show. And like every week, we did get some pretty good questions. So the first one that comes in is from Paul. He's down in Spring Lake, New Jersey. He writes in, Ryan, I guess I should have known better, but for some reason I was under the impression that I would have to pay taxes on my Social Security benefit, or I wouldn't have to pay taxes. You're wrong about that, Paul. Now I know better, but it seems like some people pay more than others. How does this work? Well, we've talked about this on the show before, but Social Security is a lot more complex than you think. There's a lot of different ways for you to take your Social Security benefit. In fact, we've actually built a calculator so we can run all the different options for you. So, one thing I want you to think about is the best way for you to take Social Security is probably not the best way for your neighbor, your cousin, your sister, your brother. It's all going to depend on your specific situation. And the one thing, Paul, I'm guessing here is if you take Social Security early, which is 62 for most of us, and you're still working and you make over a certain income threshold, which is somewhere around $15,000 to $17,000, you start getting penalized and have to start giving money back in taxes for taking that benefit. Whereas you don't get penalized, but you still get taxed on Social Security at your full retirement, for many of us is at 66. So that's just one component to Social Security. Bob, and I can go on with many other nuances and differences than when it comes to taking Social Security, and that's why I think our Social Security calculator is so powerful.
Well, it makes a big difference, and it does make a big difference at what stage in life you do take it. Well, the majority of people take it at 62, although it's probably not a bad idea if you're not working. because it takes, till age 80 to break even if you wait until you're 66 to take the full benefit, Ryan?
Pretty close. I mean, depending on if the money's invested, there's a lot of things to look at, but that you can extend it out where your break even can be very late. And, on an actuarial table, as Americans, we probably live close to age 79, 80 if we're male, a little bit longer if we're female. So it doesn't really make it a home run whether to take it early or late, but then taxes play into it. And then on top of that, how old your spouse is factors into it. And, depending on your age, they may be able to draw on your benefit, your spouse, depending on how much money you made. So you can see, I mean, there are so many variables when it comes to Social Security, which seems like it should be a very straightforward thing.
Well, it seems to get very complex. And then again, of course, is the question is how liquid is Social Security? Is it going to be there? At what age do you stop planning to have Social Security when you retire? I think my generation is not going to see a default in Social Security, but what about the millennials, Ryan? What can they do?
Well, I'm somewhere in between millennials and baby boomers. My guess is I'll be able to collect at age 90. So it's going to be a long time. They're just going to keep pushing that age back. I think that's the strategy there. Next question comes in from Rebecca. She's in Greenwich, Connecticut, and she actually writes in, Bob, unless something goes horribly wrong, I should be getting a sizable inheritance from my mom. Bob, don't hesitate to give me an inheritance, too. She's currently 90 years old and in declining health. Is it unwise for me to factor that inheritance into my retirement planning?
Well, Rebecca, that's a great question. And when it comes to retirement planning, it shouldn't be just one document that you put together somewhere in your life and stick in a drawer and hope everything works out. Planning for retirement, especially doing wealth projections, this should be a living, breathing document, something that you should update every year. And you absolutely should include inheritance into your what-if planning. You should also include, your home into your what-if planning. But, we don't like to depend on things that we don't have an exact date of when, they'll be available. For example, a lot of people think they're going to downsize their home and live in a smaller home or an apartment or actually rent, and they're going to live off the money that they generate from the sale of their home. Well, a lot of things could be wrong-headed about that. First of all, you got to live somewhere. And even when you downsize, some of the homes that you want to downsize to cost just as much as a house you want to liquidate and sell. So it's not always a great strategy. So we don't count those into the analysis until it actually happens. Same thing with inheritance. We want to put it there and see what if your mom lives only till 91, or what if she joins the fastest growing segment of the population, Rebecca, which is people living over 100. So your mom may live over 100, and healthcare costs start to skyrocket as you get older. So a lot of that inheritance may be eaten up in healthcare costs. You just don't know. So we don't want to depend on it, but we certainly want to plan on it, and we also want to incorporate it into our planning so that we make the right decisions on how to invest your money. And that's what we call the whole A to B strategy, something that Ryan and I have been doing for people now for over 40 years. And it's something that you need to do. And if you don't have an A to B strategy, if you can't open your drawer right now and pull out the latest projections, it's something that you need to do right now, Rebecca. Ryan, is there anything else that people are incorporating into their what-if scenarios that maybe Rebecca could benefit from?
No, I think what it comes down to, Bob, I think you hit the nail on the head, is that key is a working document. And I think that's one thing that's lacking is how many times have we gone to a quote-unquote financial planner advisor. They put together some sort of retirement projection, and that's it. One and done. That was 15, 20 years ago, and nothing's been updated since. And, these are things, we always say retirement is not a destination, it's a journey. So even planning for retirement's a journey, and then being in retirement's a journey. This stuff needs to be updated quite often, and it's important that you're working with, technology, you have software that can be constantly updated and manipulated to change what the goals are and what the scenarios are, so you know what all your risks are. Because if I'm in your shoes, in this case, Rebecca, I'd want to know, what does my retirement look like with that inheritance, and what does it look like without it, and look at those numbers every 12 months. So, I think as you're planning, as you're getting ready for retirement, just make sure that you do have a plan that's being updated on a regular basis. If you're not seeing an update every 12 months from your advisor, you have a real problem.
Rebecca, in your email, you mentioned, unless something goes horribly wrong. Well, I'll tell you what's going horribly wrong in our country today is elder abuse. So you want to make sure that you're keeping an eye on your mom's account, because as we get older, we become more susceptible, to scams. and we see it more often than we'd like. So keep an eye on that. Now, if you're wondering, should you incorporate your family's inheritance into your plan, or have you updated your plan, or you don't have a plan? Well, what we'd like to offer, if you're one of the next few callers, we have a few spots left, and you've saved over $200,000 for retirement, Ryan and I will run for you our total financial master plan. There's no obligation, there's no cost, but you have to call. And if you're one of the next few callers, here's what we'll do for you. We'll have our CPA partner review your most recent tax return. Be certain that you're utilizing all the tax benefits that are legally available to you under today's code. Secondly, we'll review your wills, your trusts, your beneficiaries to make sure that the right people are named in the right places. And lastly, we're going to look at all your investment statements. We don't care where they're custodied. You don't even have to open the envelope, stick it in a shopping bag, bring it in, go on in, we'll do all the work. And we'll reduce those statements down to our famous investment analysis spreadsheet. This is a simple 3-page document that tells you all the things you need to know about a portfolio. Are you diversified? How much risk are you taking in that portfolio? What are the pitfalls that you may not be aware of? What are your fees? Are you being overcharged on your investments? We're going to identify every fee, especially those hidden costs that are buried deep into your annuity contract or in the prospectus of your mutual fund portfolio. And lastly, we're going to look at income. We're going to look to optimize the cash flow, especially for those of you entering into retirement, to make sure you have a more dependable income stream. And finally, we're going to tie it all together and do a wealth projection, which will answer the age-old question for you. Are you going to outlive your money, or will your money outlive you? And we're going to do that utilizing strategies that we've been perfecting now for over 40 years. That's right, 4 decades at Payne Capital Management. We want to help take you from point A to point B, your goals, your dreams, with the least amount of risk and the highest odds of success.
So call us, 844-PLAN-NYC. That's 844-752-6692. Get the full review. We have a few slots left. If you have over $200,000 saved for retirement, 844-PLAN-NYC. That's 844-752-6692. This is your shot to do it at 844-PLAN-NYC. That's 844-752-6692. This is No Pain, No Gain Financial Radio.
Hey, we know you love the show, but we also know you're on the go. That's why we want to make No Pain, No Gain more accessible to you. Go to BeBullish.com and download the show. Listen on your schedule. You can even find a written copy that's helpful for you, whether you're in your car or at the office. Take us with you and learn about your finances. Visit BeBullish.com. That's BeBullish.com.
Here's this week's Spotlight on No Pain, No Gain.
It's time for this week's Spotlight. Each week we dissect someone's real financial plan and uncover the flaws, or we call pain points. That's P-A-Y-N-E, of course. So you can avoid the same mistakes with your own planning and investing. And to help us through this week, we have our favorite financial friend, my colleague, financial advisor here at Payne Capital Management, Frankie, or Francesca Lagrateria. Good morning, Frank. Thanks for being on the show.
Good morning. Thanks for having me, guys.
It's always a pleasure. So you worked on a case in the last couple weeks, and you found a lot of issues with the way this couple was planning for retirement. So why don't you walk Bob and I through some of the pain points that they had?
Actually, I would say their biggest problem was the fact they weren't planning. They didn't have a cohesive plan was really what the issue was. They had, some 401k assets. They had a, annuity. They had some investments here, some investments there. But overall, they didn't have one singular person or one singular team looking at the whole spectrum and saying, why do you have these in place? Why do you have this annuity? Why are you invested this way? Let's plan for our goals. Let's invest for our goals.
Yeah, and that's actually a common thing. We see it all the time. It's like you've been saving all these years. You're maxing out your 401k, and you're kind of hoping for the best. And I feel like a lot of times a light bulb just goes off like, wow, I've accumulated some assets here. Retirement's 10 years, 15 years away. I need to get a plan in place finally. It's just all of a sudden, it's just like a light clicks, I feel like, for a lot of people.
Absolutely. And I think that's what's such a good thing about this right here is that we kind of take a look at all the different spectrums. So what we did for these people specifically was, like I said, they had an annuity. So we took a look at that. We're saying, hey, do you know how much you're paying? They were paying over 2% in fees.
I see 2.61%, almost over 2.5%.
Yeah, I was going to say over 2.5% in fees, and they had no idea. And then when we gave the annuity company a call, we found out the bells and whistles, none of that even applied to them. They didn't even need these bells and whistles that they were paying for. So what we were able to do was, take a look at that, run an analysis on it, and say, do you even need this annuity? So luckily we found out their surrender value, what we can do, what taxes would be involved with this, because all of this plays into effect, and we were able to get them, going on the right track in a much cheaper, tax-efficient way.
So they get to pay additional fees for less attention. And I'm looking at the investment analysis spreadsheet, and this is what happens when you have a lot of different custodians. You end up with overlap in your portfolio because everything's being run as a separate island. And I think that the beauty of what you did here, Frankie, is by putting it on the spreadsheet, it showed how they had the same investments in all these different custodians, thinking they were diversified, where they had tremendous overlap with over 33% in large growth and 21% in large value, and missing out on some of the great return opportunities that are available in other parts of the investment spectrum.
And that's the thing. It's like there's 10,000 plus companies traded publicly, but most of us only have like 500 of those in our portfolio. It's crazy. It's unbelievable how often, to your point, Bob, I like that too. It's like, yes, we tend to manage all of our different portfolios as their own little island, whereas they're all part of the same goal, and that's getting to retirement.
Yeah, what is that?
I think a lot of people think risk diversification is
Exactly.
just to diversify advisors or custodians, where you really need a financial quarterback like Frankie to put it together and say, why do you want to own the same investment over and over again? Now, it's great if it goes up, if it's an Apple or a Google in this environment, but it's horrible if it turns out to be an Enron or a Merrill Lynch that goes under.
Oh, absolutely. And even some of the things like international, they were skimped on that. And that has a huge run this year. Year to date, international is doing better than our U.S. markets, and they missed out on that huge run because they weren't diversified properly.
Well, it's a good thing you're there to save them, Frankie.
What other pain points? I see a couple here. Did you see that this couple had?
I would say a big one that they also had was bond funds. So a lot of their money was in retirement assets. So I know those 401ks, you're kind of at helm to what your options are. But in your other accounts, having bond funds is not as safe as you think it's going to be. If you really want to have that safety in your portfolio, I know Bob and Ryan talk about this all the time, but you need to own your bonds outright. And I am such a stickler on that.
Well, it's the only hedge, that true hedge in a portfolio is to have fixed income investments that mature. I mean, if it's not a fixed income investment, it means the interest rate can fluctuate. How do you plan if you don't know what the rate of return is going to be? And secondly, when you get into an interest rate environment where rates go up, which we haven't seen in 36 years, and we've been in a bull market in bonds for 36 years, so most of the advisors that these people are working with have never seen a bear market in bonds, like these old people that work at Payne Capital like me. But the whole point is the only true hedge is to have an investment that comes due so you can get your money back and you get to start all over again and take advantage of whatever the dislocations are in the market at that given time.
Absolutely. And you want to also know what you're owning. I mean, how many people have bond funds in there that had, Puerto Rico bonds, New Jersey bonds, Atlantic City bonds, for the love of God.
What about Illinois?
Yeah, Illinois bonds. You don't really take the time to sit there and look at it. And you could have it just filtered with all this junk in there.
And they also, I just saw a good article this past weekend in Barron's talking about if you own a bond ETF or exchange-traded fund, they've never been tested in a down market before. So in terms of uncertain liquidity or the underlying, and we're talking about the different kind of bonds you can own in there, we have no idea what that's going to look like during a crisis. And with interest rates starting to rise, there's a lot of risk there that's never been seen before. So you want to know, too, that you have a time-tested type portfolio that in any given market, we know how it's going to react. And if you own bond ETFs specifically right now, we have no idea what that's going to look like, which that makes me really nervous. And if I'm getting close to retirement, I do not want those in my portfolio.
I think the whole thing about the Total Financial Master Plan is not just about portfolio analysis. It's also about retirement planning. It's also about tax planning and estate planning. What were some of the pain points, Frankie, that you found with this lovely couple?
Yeah, Bob. So actually, with their taxes, we found out that since both of them are looking to retire before 70 and a half, so before they have to take that RMD or required minimum distribution, we could actually do some creative planning. We could do some, Roth conversions where we start pooling from their IRAs and putting them into their Roth account so that their RMD amount isn't as large at 70 and a half.
Yeah.
And they had
Great
no
strategy.
idea that was even an option for them. So they were, it was pretty exciting.
Well, that's a huge thing because how many of us, we have these big IRAs, they're a ticking time bomb for taxes once you hit 70 and a half. So doing some sort of IRA planning ahead of time is so smart, and just another reason why that total financial master plan can address all these issues.
You had a
why-
will where only one spouse had a will.
Yeah.
That's a problem.
That's a big gap in the estate plan.
Yeah, I mean, unless she shoots them.
Wow, Frank. That's why you
that
want to
kind
be
of
one of
advice,
Frankie's financial friends. Well, on that note, well, great job on this case, Frankie. Great job just looking at getting them better diversified, getting rid of their bond funds, making sure that the estate was up to date, and some creative tax planning they can do. And if you're sitting there thinking to yourself, this is the type of plan I need that addresses everything, not just the investments, but my whole financial life, here's your shot to do it. We still have a couple slots left. If you give us a call right now and you have over $200,000 saved for retirement, myself, Bob, and Frankie will run for you our total financial master plan, and we'll do it with no obligation or cost. It's a full review just like this. We're going to look at taxes. If you bring in your tax return, we're going to make sure you're not paying unnecessary taxes. We're going to make sure that your IRAs are not a tax time bomb. We're going to look at the estate plan. Do you have updated wills? Do both of you and your spouse have wills? That's important as well. So it'll tell you what you need to be doing with your estate. And if you bring in all your statements, bring those 401ks, IRAs, annuities, insurance accounts, we're going to put it all together on one simple investment analysis spreadsheet, and we're going to look at all these things. We're going to look at diversification. Do you have too much money concentrated in too few areas? We're going to point out those pitfalls. What about income? We can increase this couple's income by $15,000 a year. Can we increase the income on your portfolio, which is so critical for retirement? And we're going to look at fees. Do you have high-cost annuities? This couple's paying 2.6% a year in fees that they didn't have to pay. What fees are you paying that you shouldn't be paying? We're going to break that down for you as well. Then we're going to tie it all together into one total financial master plan to make sure that you are not going to outlive your money will outlive you, utilizing strategies we've worked on for literally 40 years to take your family from point A to point B with the least amount of risk and the highest odds of success.
Don't miss out. Be one of those last few callers and call us at 844-PLAN-NYC. That's 844-752-6692. If you're one of the next few callers and you've saved over $200,000 for retirement, our team will run for you our total financial master plan. There's no obligation, there's no cost, but there's no plan if you don't call. 844-PLAN-NYC, 844-752-6692. This is No Pain, No Gain, Financial Radio. Another great show, Rye. What do you got going for the rest of the day?
I'm going to just chill out, hang out, and enjoy the beautiful weather. Frankie and her financial friends, what are you doing this? I just like saying that. What are you doing this weekend, the rest of the weekend?
Frankie and her financial friends, I'm actually going camping. So,
Wow.
yep, I have to go back to the woods now.
We'll come back safe and sound, so we'll be a little concerned that you're out there in the wilderness.
Watch out for those liars, charlatans, and bears. Oh, my.
Well, another great show, and as always, be bullish.
Information provided on today's show is provided for information purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with an investment, legal, or tax professional before taking any action.